Dear students, greetings. I hope that you all are living safely at home. Today we discuss about capital budgeting. As we already completed 3 by 4th of this chapter in the classroom itself. The remaining part we will discuss in this class. How to calculate NBB for a project. As we have already completed meaning of NBV, advantages as well as disadvantages of NBV in the classroom, now we discuss how to calculate NBV for a project. See the illustration. In the illustration you can see two columns, one column for year and second column for cash flows, that is for project A. Cash flows are given from year 0 to 5. Remember that 0 period cash flows is cash outlay, or in other words we can say that initial investment or initial capital investment. Calculate NBV for project A at 10% discount factor. Okay, the discount factor will also given in the question. Now see, there are 4 columns. First column for year, second column for cash flows, third column for discount factor, and the last column for present value of cash flows. Column 1, 2 and 3 will be given in the question. I repeat, year column, cash flows column and discount factor column will be given in the question. We need to calculate only present value of cash flows. Calculation of present value of cash flows is as easy as cutting a piece of cake. See, cash flows multiplied by discount factor, we get present value of cash flows. See, first year 5,000 multiplied by 0.909 equal to 4,545. I repeat, 5,000 multiplied by 0.909 equal to 4,545. We repeat the same for year 2, year 3, year 4 and year 5. Year 2 you say, year 2 see 10,000 multiplied by 0.826 equal to 8,260. Once we calculate present value of cash flows for all the year, the next step we need to add the total of all the present value cash flows. Just find the total of present value of cash flows. Okay, so the total of present value of cash flows is equal to 23,606. Then initial investment is given in the question. Initial investment is the 0 period cash flows. So 0 period cash flow is given in the question, 20,000. Therefore, NBV is equal to present value of cash flows minus initial investment. I repeat, NBV is equal to present value of cash flows, that is total present value of cash flows minus initial investment. So for project A, we get NBV 3,606. Okay, I hope that you understand this one, because it is not difficult. Everybody can understand how to calculate NBV. The decision rule relating to NBV we already discussed in the class. I repeat, if NBV is greater than 0, we accept the project. If NBV is less than 0, we reject the project, and if NPV is equal to 0, it is indifferent. Depends on the management whether the project should be selected or not. Now we go for another method that is called IRR, internal rate of return. Internal rate of return is one of the modern methods of capital budgeting. It is the interest rate at which net present value of all the cash flows from a project equal to 0. A higher IRR is more desirable to the project or to select the project. Now let us see the advantages of IRR. IRR incorporates time value of money. The first advantage of IRR is that it incorporates time value of money. The second advantage is that this method considers all the cash flows. I repeat, this method considers all the cash flows. And the last advantage is that it provides a very close rate of return. Now we go for the disadvantages of IRR. Calculation of IRR are not simple for an average person. That means calculation of IRR is little difficult. It cannot be followed by an average common person. Second disadvantage. In case of multiple cash flows or multiple rates, decision making become difficult. Now let's see another method, ARR, that is accounting rate of return. It is the percentage rate of return expected on investment as compared to the initial investment. Advantages of ARR, that is accounting rate of return. The first advantage is that it is easy to calculate and simple to understand. It is easy to calculate and simple to understand. Second advantage, it takes into consideration the total earnings from the project. Now let us see what are the disadvantages of accounting rate of return. The first disadvantage is that this method ignores time value of money. Second disadvantage is that it is based on accounting profit, not on cash flows. Different methods are used for calculating accounting profit. So there is a vagueness in the calculation of project profit. The third disadvantage is that it ignores the reinvestment potential. So these are the advantages and disadvantages of accounting rate of return. Now let us see the formula how to calculate accounting rate of return. It is very simple. Accounting rate of return is equal to average annual profit divided by initial investment multiplied by 100. Let us see an example. See the example in the slides. ABC company provides the following for the year 2019. Average annual profit is 20,000. Initial investment is 100,000. What is the accounting rate of return? Very easy, just apply the formula. What is the formula? accounting rate of return equal to average annual profit divided by initial investment multiplied by 100. So average annual profit is given in the question 20,000. Initial investment Omani Riyal 100,000 multiplied by 100 equal to 20%. That is, accounting rate of return is 20%. Now let us see the last capital budgeting techniques or method, that is profitability index. Profitability index is also known as profit investment ratio or value investment ratio. It is a financial tool which tells whether an investment should be accepted or rejected. We can calculate profitability index with the formula present value of future cash flows divided by initial investment. I repeat, profitability index is equal to present value of future cash flows divided by initial investment. Now let us see the decision rule. If profitability index is greater than 1, we accept the project. If profitability index is less than 1, we reject the project. And if profitability index is equal to 1, what to do? It is indifferent. It means that it depends on the management to take up the project or not. See one illustration. We know the formula how to calculate profitability index equal to present value of future cash flows divided by initial investment. Now we will go to an illustration. See this illustration we have seen while studying NPV. See here, we can see here total present value of cash flows. Present value of cash flows, right? So we need this one to find profitability index. See, profitability index here you can see here 23,606, that is present value of future cash flows. Now see, initial investment is given in the question. See, initial investment how much? 20,000. So divide by initial investment. So profitability index we get 1.18. So can we accept this project? Of course, we can accept this project because profitability index is more than 1. If more than 1, according to profitability index, we can accept this project. That's all. I hope you understand what we discussed in this class. If you have any doubt, please revert back to me. Thank you very much. Stay safe.